We're going to talk markets now ahead of the inflation data, as well as Justin Timberlake with Gabriela Santos this morning, Chief Market Strategist for the Americas at JPMorgan Asset Management. What do you think of him, the singer? No.
JT?
Yeah.
Has a beautiful voice.
Yes, he does.
Beautiful.
Yes, he does.
Good golfer.
And he's a good golfer.
Trolls.
Yeah. So, okay. Now we've gone.
Yes.
We've gone off the rails. Gabriela, we've been talking about. We're going to get these PPI numbers later today.
That's
I
right.
think, and we're also watching, I don't know if we're calling this a melt up. What are we calling this in terms of what's happening in the market right now?
Well, we had a very brief 5.5% pullback for parts of April, and then almost a full rebound, less than 1% from all-time highs. So ultimately, I think it's just a continuation of the bull market here, the bull case. And I think ultimately, for the bond market, for the FX market, it's still very much all about what's happening with inflation and the exact timing of Fed rate cuts. But I think when it comes to risk assets like equities, like corporate credit, I think we've kind of moved on a little bit. There's more confidence in the base case, which is 2.5% growth, inflation that's normalizing over time, and a Fed in December and then again in May that took rate hikes off the table. And that's an environment where you can have great earnings growth and you can have a continuation of the bull market and very tight corporate credit spreads.
How concerned are you, though? We were talking, I'm trying to think who the guest was that mentioned this. When we think about a presidential cycle, if we don't know who's going to win, there's often a pullback in spending, both in terms of capital spending by businesses because they're not sure what's about to happen, and sometimes even consumer spending. Do you think that's in the offing or no?
I think what's been interesting is in terms of the bond issuance this year, we've had record investment grade, high yield issuance for this part of the year.
Right.
And we've been hearing that perhaps part of that may be taking advantage, that the market is open and doing it far enough in advance of the election. So perhaps that's already impacting certain decisions like that. But if we look at, for example, the Business Roundtable survey of companies, 40% of CEOs say they still plan to increase CapEx over the next 12 months. So I think it's very much an impact at the margin in terms of election decisions.
I wonder how much of it is there's just so much liquidity sloshing around. I mean, the idea that you see a 5.5% pullback and all of a sudden everybody rushes in from the sidelines. What happened yesterday with the meme stocks, which is crazy to see that. I mean, this is a market that has plenty of liquidity, and maybe the Fed should pay attention to that, too.
And we've talked about so much about the $6 trillion plus of cash in money market funds for a lot of people that were waiting for the hard landing last year, that were waiting for a more meaningful correction to get invested because they were afraid to invest at all-time highs. And I think what you're seeing is really just a capitulation. Look, the hard landing risk is always there, but it's really decreased. Overall, the base case has been underwritten, and investors want to participate in risk assets. So any kind of little pullback, you see investors buying equities, but also buying corporate credit and buying international equities as well.
I know it's not something you focus on, but what do you think of this whole GameStop situation all of a sudden coming back in the marketplace? Does that say something more broadly about where we are?
I think it says a lot about the psychology and the investing behavior of different generations. And I think it's really interesting to see that, especially for millennials, for Gen Z investors, there's a lot more focus on the short-term investing behavior.
It's kind to call it investing. You know, it's kind to call it investing.
Exactly.
Trading and gambling.
It's trading, it's gambling, it's quick payoffs. Instead of, look, we're investing for 5 years, 10 years, which is ultimately the time horizon we should have for equities here. So I think a lot of that is a reflection of a new generation of investors. And in part, it's good. I think especially given the low affordability of housing now, to build wealth for the younger generation is going to have to be through financial assets versus real assets like housing. But it's important to change the mentality, to be much more long-term investing than trading. And there's tons of interesting opportunities in the long term, both here in the U.S. as well as overseas, especially in Asia.